Interest rates are on the rise, and you're probably starting to feel the impact. But what exactly does this mean for you and your finances? In today's video, we're breaking it down. If you've been following the news lately, you've probably heard about rising interest rates. The Federal Reserve has been increasing rates to combat inflation, but how does this affect your day-to-day life? Let's dive in. First things first, what exactly are interest rates? Simply put, they're the cost of borrowing money. When interest rates go up, borrowing money becomes more expensive. The Federal Reserve, or the Fed, sets the benchmark rates that influence how much banks charge when you take out a loan or put money in savings. So, if you're thinking about buying a home, taking out a car loan, or even getting a new credit card, higher interest rates could mean higher monthly payments. Let's explore what that really looks like for different people. For homebuyers, rising interest rates can add up quickly. Suppose you're taking out a 30-year mortgage for $300,000. With a 3% interest rate, your monthly payment would be around $1,265. But with a 6% rate, that same mortgage will cost you about $1,798 each month, an increase of over $500. That's a pretty big difference. And if you're already struggling with high home prices, these higher rates can make it even harder to afford a home or even qualify for a loan in the first place. For those carrying credit card debt, higher interest rates can sting even more. If the Fed raises rates, credit card companies usually raise their rates as well. That means if you have a balance, it will take longer to pay off and cost you more in interest. Let's say you have a $5,000 balance on your card, and your interest rate increases from 15% to 20%. Your monthly payment will go up, and you'll pay more in the long run. It's definitely a tough situation if you're already struggling with debt. On the flip side, if you're a saver, higher interest rates can actually work in your favor. Bank savings accounts, CDs, and money market accounts generally offer better returns when rates go up. So, if you're saving for a big purchase or a retirement, you might see a little extra boost. That's a silver lining for people looking to grow their savings. Higher rates mean your money can earn more in certain types of accounts. But there's a catch. Beyond individuals, rising interest rates can have a broader effect on the economy. When borrowing gets more expensive, businesses may cut back on investments, and consumers might reduce spending. This slowdown can help cool off inflation, but it also means slower economic growth. In the short term, higher rates can feel uncomfortable, but they're part of the Fed's strategy to get inflation under control. It's a balancing act. If inflation stays high, prices will continue to rise across the board. If the economy slows too much, it can lead to a recession. So, what can you do to protect yourself during times of rising rates? Here are a few tips. 1. Refinance your debt. If you have high-interest loans, refinancing at a lower rate might save you money. But be careful, as rates are rising in most places. 2. Pay down high-interest debt. Try to pay off credit cards or personal loans faster to avoid getting hit with high-interest charges. 3. Consider fixed-rate loans. If you're taking out a mortgage or a car loan, locking in a fixed rate can help you avoid future rate hikes. And 4. Save smart. Take advantage of higher interest rates by putting your money into savings accounts or CDs that offer better returns. With rates going up, it's more important than ever to be strategic about your finances. Stay informed, plan ahead, and keep an eye on your spending. And remember, rates aren't going to stay high forever, so adapt as needed. That's all for today's video. I hope this helps you understand how rising interest rates affect you and what you could do about it. If you found this helpful, give us a like, subscribe for more content, and share it with friends who might need this info. Until next time, take care of your finances.